They say the biggest threat to your portfolio isn't the market, it's you. Every investor, beginner or pro, fights the same invisible enemy, emotions. When prices fall, fear whispers, sell before it gets worse. When prices rise, greed shouts, buy more, this is your chance. And somewhere in between, doubt creeps in, maybe I should have done something different. These emotions, fear, greed, doubt, are not signs of weakness. They're part of being human. But in the world of investing, emotions are expensive. Most people lose money not because they choose the wrong stocks or funds, but because they make decisions at the wrong time. They panic when things go down. They chase hype when something suddenly explodes on social media. Think about the crypto boom or meme stocks like GameStop. Thousands of new investors jumped in because everyone was talking about getting rich fast. And when prices crashed, those same people sold everything in fear, often at the very bottom. It wasn't the market that beat them. It was emotion. The market is like a giant emotional mirror. It reflects the psychology of millions of people: fear, hope, greed, all at once. That's why charts look like roller coasters, ups and downs powered by human behavior. Smart investors don't try to predict emotions. They control their own. Here's a story. In 2008, during the global financial crisis, markets dropped by more than 50%. People were terrified. News headlines screamed, "Worst crash since the Great Depression." Many sold everything and promised never to invest again. But those who stayed calm, who kept investing regularly within 5 years, they not only recovered their losses, but doubled their portfolios. Why? Because they didn't let fear decide for them. They understood that the market's mood swings are temporary, but discipline is permanent. Here's a simple mental trick. Imagine your investments are trees in a garden. Some seasons bring storms, others bring sunshine. You don't dig up your tree every time it rains, you wait for the sun to return. The same goes for markets. When you stay patient, you allow growth to happen over time. Another dangerous emotion is overconfidence. It's the belief that I can time the market or I know what's going to happen next. Even professional traders with decades of experience often fail at predicting short-term moves. If experts can't do it consistently, why should you or I try? The truth is, it's better to have a consistent, humble strategy than a risky guess. One of the best ways to protect yourself from emotional mistakes is automation. Set up automatic investments. For example, investing a fixed amount every month into an index fund. That way, you buy when prices are high and when they're low, without emotion guiding your hand. It's called dollar cost averaging, and it's one of the simplest ways to stay calm in chaos. Another method: write down your investing rules. For example, I will not sell during market drops unless I need the money for real life. When panic hits, having that rule written down keeps you anchored. It's not about being fearless, it's about being prepared. At the end of the day, the first rule of investing isn't buy low, sell high. It's know yourself. Because once you understand your reactions, the market loses its power over you. Remember, markets rise and fall. Trends come and go. But your mindset, that's what determines your long-term success. The enemy isn't out there on a trading chart. It's inside in fear, greed, and impatience. And once you master that, you don't just invest smarter, you invest stronger.
Now that we know the biggest enemy is inside us, let's talk about how that enemy shows up and how to fight back. Emotional traps are the little psychological tricks your brain plays on you when money is involved. They're invisible, but powerful. And the worst part? They make you feel like you're being logical, when in fact, you're reacting emotionally. Let's go through a few of the most common ones. Trap number 1, the panic button. You check your investment app one morning. The market is down 3%. Your portfolio shows red. You feel that familiar sinking feeling in your stomach. Your brain says, sell now before it gets worse. That's panic, the body's natural fight or flight response.
It worked great when humans faced lions. But in investing, it's the fastest way to lock in losses.
Smart reaction. Pause. Don't act immediately. Markets fall, it's part of the cycle. Even the S&P 500, one of the world's most stable indexes, drops multiple times a year. But every historical dip has eventually been followed by recovery.
If you sell in fear, you make those temporary losses permanent. Here's a useful phrase: don't make permanent decisions based on temporary emotions.
Trap number 2, the greed rush. When markets rise fast, like during crypto booms or stock surges, everyone starts talking about profits. Social media fills with screenshots of gains. YouTube thumbnails scream, "I made $10,000 in 1 week." That's when greed takes control. Your mind whispers, "You're missing out. You should get in before it's too late." This is called FOMO, the fear of missing out. But here's the irony. By the time everyone's talking about an asset, it's often already overpriced. You're not early, you're late. Smart reaction. Stick to your plan. If your investment strategy doesn't include chasing trends, don't start now. Most of those overnight success stories come from luck, not skill. And luck runs out. Remember, the crowd is loudest at the top of the market. Trap number 3, overconfidence. After a few good trades, you start feeling unstoppable. You believe you've figured out the market. Maybe you made some quick profit buying a stock or crypto at the right time. Your brain rewards you with dopamine, the same chemical that drives gambling. You start taking bigger risks. And suddenly, one bad move wipes out months of gains. Smart reaction. Stay humble. Confidence is good. Overconfidence is dangerous. Even Warren Buffett, one of the world's most successful investors, says, "The market is designed to transfer money from the active to the patient." It's better to be consistently good than occasionally lucky. Trap number 4, the prediction illusion. Many investors fall into the trap of believing they can time the market, selling at the top, buying at the bottom. But if it were that easy, everyone would be rich. The truth? Even experts fail to predict short-term movements. Economic data, news headlines, interest rates, the list of variables is endless. Trying to guess the future is exhausting and almost never profitable. Smart reaction. Focus on time in the market, not timing the market. Invest regularly, hold long-term, and let compounding do the work. It's boring, but it works. Trap number 5, the comparison game. You're proud of your portfolio until your friend shows you theirs. Suddenly, you feel like you're doing something wrong.
They made more money. They bought a hot stock. They invested in crypto early. Now you start questioning your own plan.
Comparison is poison, because no two investors have the same goals, timeframes, or risk tolerance. Someone saving for a house in 3 years shouldn't invest like someone saving for retirement in 30. Smart reaction. Define your own goals. Your journey is yours. If your investments are moving you toward your personal targets, you're winning, regardless of what others are doing. Let's recap. Fear makes you sell low. Greed makes you buy high. Overconfidence makes you take unnecessary risks. Prediction makes you chase illusions. Comparison makes you lose focus. Every one of these traps is emotional, not financial. That's why emotional control is one of the most valuable investing skills, and it's completely free. You don't need a PhD to control fear. You don't need a Wall Street job to stay patient. You just need awareness and a plan.
Next time you feel an emotional impulse, pause. Ask yourself, am I reacting to data or to emotion? If it's emotion, step back.
The best investors aren't the smartest ones. They're the calmest. They know that wealth grows slowly and emotions pass quickly.
We understand the emotional traps that sabotage investors. How do you build discipline strong enough to resist them? Emotional discipline isn't innate. It's trained like a muscle, developing strength over time. The earlier you train it, the stronger it becomes, leading to rational investment decisions. Let's explore how. Our first step is a meticulously written strategy, a roadmap for your financial journey. When emotions run high, logic often shuts down, making impulsive decisions detrimental to your portfolio. Every investor needs a written plan, a guide for good times and bad, ensuring you stay on course. Your plan can be a simple one-page document answering 3 fundamental questions. For example, I'm investing for retirement in 30 years. I'll invest monthly in an index fund. If the market drops, I will not sell, I'll keep buying. This simple page can save you from emotional chaos, providing clarity when uncertainty strikes. When fear hits, you follow your predetermined rules, removing guesswork. Smart investors make decisions before emotions appear, based on their well-thought-out plan. Step 2 involves automating everything, removing yourself from the day-to-day investment process. Automating transfers ensures consistent contributions, removing emotion from investing. Invest a fixed amount monthly, regardless of the market. This is dollar cost averaging. This method ensures you buy during highs and lows, balancing your average cost and reducing risk. It removes the stress of deciding when to invest, where emotions often lead to hesitation. Automation turns discipline into a habit, a consistent action independent of mood or market sentiment. Habits don't depend on mood. Your system reliably invests for you. Step 3 emphasizes using data, not feelings, as your guide in finance. Feelings are unreliable in finance, often leading to suboptimal decisions based on fear or greed. Great investors use numbers and facts, relying on objective evidence to guide decisions. If anxious, check history. The S&P 500 has dropped 10% or more dozens of times. It eventually recovered every single time, demonstrating market resilience. These numbers calm the mind, reminding you that volatility is just noise. Next time emotions arise, let data provide a rational counterpoint. Step 4. Keeping a journal might seem old-fashioned, but it builds self-awareness. Every time you make an investment decision, write down why and how you felt. Later, review your decisions and emotional responses to see patterns. You'll notice triggers like panic selling after scary news, or making good decisions by staying patient and sticking to your plan. Awareness is power. Seeing emotional patterns allows you to control them. For long-term investors, it's a mirror of your mindset, reflecting your inner state. Step 5 is controlling your information diet, critical in today's hyper-connected world. The more sensationalized financial news you consume, the more emotional you become. Financial media thrives on drama. Every headline is designed to make you react impulsively. Checking the market 5 times a day will likely make you 5 times more anxious. Checking once a month reveals the long-term upward trend, providing a stable perspective. Smart investors protect their attention, limiting noise and focusing on fundamentals. You can't control the market, but you can control what enters your mind, shaping your emotional landscape. Step 6 is practicing detachment, understanding that not every investment will succeed, and that's okay. Even the best portfolios have losers. The goal isn't perfection, but consistency and continuous learning. When something goes wrong, ask, what can I learn from this experience? Each mistake teaches patience, and each recovery builds confidence, strengthening your resolve. Investing is like surfing. You can't control the waves, but you can learn to balance and ride them. The more you ride, the steadier you get, navigating market fluctuations more adeptly. Finally, step 7. Think in decades, not days, shifting your perspective to the long term. Wealth is built by time and consistent effort, not speed. Compounding needs patience, not prediction. It's the magic of time working in your favor. Zoom out. Ask, what will my money become in 10 or 20 years if I stay consistent? Thinking in decades makes daily noise insignificant distractions. The best investors are often described as boring, their secret weapon for long-term success. Let's recap this powerful framework for building emotional discipline in investing. First, write your plan for clarity, not panic, providing a clear path. Second, automate investments for consistency, not impulse, building reliable habits. Third, trust data for reason, not emotion, grounding decisions in facts. Fourth, keep a journal to learn from experience, not repeat mistakes, fostering self-awareness. Fifth, limit noise to focus on signal, not fear, protecting your mental space. And finally, think long-term for peace, not pressure, embracing time's power. Emotional discipline bridges knowing what to do and actually doing it, transforming knowledge into action. Everyone understands they should stay calm, but few consistently practice it. Start today. Mastering your emotions makes the market a powerful tool. it becomes a tool that works for you, helping you achieve your financial goals. Remember this: patience builds wealth faster than emotion ever will.